Okay, let's jump right in today. We're looking at Bank of America's first quarter earnings. The numbers are out.
And they've actually managed to surprise analysts, beating expectations.
Really? What were the main drivers behind that surprise then?
Well, it looks like two key things, mainly. Stronger than expected net interest income, for one.
Okay.
And their trading revenue also came in higher than anticipated.
Got it. So let's talk numbers. What did the bottom line look like?
So profit climbed 11%, came in at $7.4 billion for the quarter.
Which is what, per share?
That translates to 90 cents per share.
Mm-hmm.
And yeah, that was definitely above the RSEG estimate. They were looking for around 82 cents.
Okay, an 11% jump and beating estimates. And revenue, did that follow suit?
It did. Revenue was up almost 6%, 5.9% to be exact, landing at $27.51 billion.
Also beating the street.
Yeah, analysts were forecasting closer to $26.99 billion. So positive on both the top and bottom lines.
All right, good start for them. And if you're finding this breakdown useful, do hit that like button and subscribe for more financial insights.
Definitely. So you mentioned net interest income, or NII. That's always a critical one for banks.
Right, the spread between what they earn on loans and pay on deposits, essentially.
Exactly. And that figure came in at $14.6 billion.
How does that compare to expectations?
It was just a little bit above, actually. Street account had penciled in $14.56 billion, so slightly better.
And why was that higher, lower deposit costs?
That seems to be part of it, yes. Lower deposit costs compared to maybe what was feared, and also getting better returns, higher yields on their investments compared to last year.
Makes sense. It really shows how sensitive they are to the interest rate environment, doesn't it?
Absolutely. Now, the CEO, Brian Moynihan, he commented on the results, naturally.
What was his take? Generally positive.
Yeah, he sounded pretty confident. He highlighted the strong performance from their business clients. Always a good sign.
And what about consumers? There's always focus there.
He noted consumers remain resilient, still spending, and crucially, credit quality is holding up well.
That is crucial. Did he acknowledge any risks?
Oh, sure. He acknowledged the economic picture could change down the road, potential shifts. But the overall message was confidence in their kind of disciplined investments and diverse business model.
And how did the market react initially? Shares up?
They were, yes. Saw a rise in pre-market trading right after the report came out.
Okay, let's dig into some specific business lines then. Trading revenue was a driver, you said?
Oh, definitely. Equities trading in particular had a huge quarter.
How huge?
Surged 17%, pulled in $2.2 billion.
Wow, that must have beaten estimates.
It did. The estimate was around $2.12 billion. And interestingly, that's actually a record quarterly haul for their equities desk.
A record, okay. And fixed income, how did that side do?
Also up. Increased by 5% to $3.5 billion. Again, just a touch ahead of the $3.46 billion estimate.
So trading seems to have been firing on all cylinders.
Pretty much. Suggests, strong market activity, good client engagement during Q1.
But it wasn't all positive, was it? What about investment banking?
Ah, right. That was the weaker spot. Fees there actually dipped by 3%.
Down to
$1.5 billion. Yeah. And that was below the $1.6 billion estimate.
Any reason given for that dip? Is it BofA specific or wider?
It seems like a broader industry trend, really. Many are pointing towards the uncertainty around global trade.
So companies getting cautious about big deals, M&A, that kind of thing.
Exactly. Economic uncertainty tends to put a damper on that kind of activity, which hits investment banking fees directly.
Okay, that makes sense. Another key figure analysts watch closely is the provision for loan losses, right? The money set aside for potential defaults.
Yes, very closely watched. It's a signal of how banks see the future, how they're bracing for, potential downturn or recession.
And how did BofA's provision look?
It actually came in better than expected. They set aside $1.5 billion.
Better than expected, meaning lower than expected.
Correct. The estimate was for about $1.58 billion. So putting aside slightly less than feared might suggest a little more optimism on credit quality than some analysts had priced in.
Interesting, especially given some recent anxieties. I remember there was concern about President Trump's tariff policies hitting the stock.
That's right. The stock had sold off quite a bit leading into this report, down over 16% for the year at one point because of those tariff worries.
And were other big banks seeing similar trends, beating estimates?
Yeah, it seems to be a theme this quarter. JP Morgan, Morgan Stanley, Goldman Sachs, they also reported earnings that topped analysts' forecasts.
And was it the same driver, trading?
Largely, yes. Particularly a boom in equities trading revenue. Seems like the market volatility we saw in Q1 actually created opportunities for these banks' trading desks.
So volatility isn't always bad for banks then?
Not for their trading divisions, no. For Bank of America specifically, their total sales and trading revenue was up 9% year over year.
9% overall, that's significant.
It is. Reached $5.66 billion. And apparently that's their best quarter for sales and trading in over a decade.
A decade, wow. Did the CFO comment on on that?
Yes, Alistair Borthwick. He gave some color. Said the results were supported by a moderately growing economy, but also,
Also the uncertainty.
yes, client concerns about trade policy and that recent market volatility actually fueled some of the activity. A bit counterintuitive, perhaps?
So uncertainty drives trading volume. What's their house view on the economy? Recession fears.
He mentioned their internal research team isn't actually forecasting a recession right now. They're seeing encouraging signs.
Like what?
Healthy employment levels, resilient consumer spending, the things the CEO also touched upon.
Okay. But going back to that investment banking weakness, that 3% dip, does it align with wider market data?
It does, unfortunately. Dealogic data showed a 13% drop in U.S. M&A activity during that same first quarter. So BofA's dip fits that broader slowdown picture.
Reinforces that trade uncertainty impact, I guess.
Seems likely, yes.
What about looking forward? Did they update guidance on NII?
They maintain their forecast for the fourth quarter, still expecting NII in the range of $15.5 billion to $15.7 billion.
And how might the rate cuts from last year play into that? Does that help borrower sentiment?
Potentially, yes. Lower rates can make borrowing more attractive, which could benefit banks like BofA. It's interesting because, before the latest tariff issues really flared up, they were actually forecasting record NII for 2025.
So the tariffs really cast a shadow.
Seems so. Reports suggest investment bankers globally are definitely feeling more cautious, sort of hitting the brakes on deal-making because of that uncertainty.
Right. Now, about those credit provisions again. $1.5 billion set aside. How does that compare to last year?
Good point. While it beat the immediate Q1 estimate, it is higher than the $1.3 billion they provisioned in the same quarter last year.
So year over year, they are setting aside more.
Correct. Which suggests that, despite the better-than-expected figure this quarter, they are still factoring in the possibility of credit conditions worsening down the line compared to a year ago.
So a degree of caution remains.
Definitely. Moynihan talks about responsible growth. That's their mantra. And Borthwick, the CFO, reiterated their base case is modest growth. And they believe any uncertainty-driven slowdown will be temporary.
But they are preparing, you said $1.5 billion provision, but was there another figure related to provisions mentioned?
Yes, the $1.48 billion in total credit provisions set aside. That specific number is actually up over 12% compared to what they set aside in Q1 of last year.
Over 12% more year over year. That does signal a cautious stance, doesn't it? Expecting things might get tougher.
It certainly points that way, expecting potentially worsening credit conditions compared to last year's outlook.
So wrapping it up, it sounds like a complex picture for Bank of America. Strong trading thanks to volatility, maybe?
Seems like it. But then headwinds in investment banking, likely tied to those broader economic jitters, like trade policy.
And while the headline numbers beat expectations, there's this undercurrent of caution shown by the increased provisions year over year.
Exactly. Cautious optimism might be the best way to describe it. They're performing well now, but clearly preparing for potential shifts ahead.
It really highlights how these global economic policies and market swings create both, well, opportunities and challenges for these huge financial institutions.
Absolutely. It's a balancing act.
Thanks for walking us through those BofA results. Really appreciate the insights.
Glad to do it. Always interesting to see how these numbers play out.
And thanks to all of you for tuning in. Don't forget to like and subscribe if you haven't already. We leave you with a thought. Beyond interest rates and trading volatility, what other factors do you think will be most critical for Bank of America's performance in the coming quarters? Something to consider. We'll catch you next time.